Dividend investing and growth investing are two different strategies for long-term wealth accumulation. Dividend investing involves investing in stocks that pay out a portion of their earnings to shareholders in the form of dividends. The goal is to generate a steady stream of income from these dividends over time. On the other hand, growth investing involves investing in stocks of companies that have the potential for high growth in the future. The goal is to benefit from capital appreciation as the company grows and its stock price rises. The key difference between these two strategies is their focus. Dividend investing is geared towards generating income, while growth investing is geared towards capital appreciation. When it comes to dividend investing, investors are looking for stocks that pay out a consistent dividend and have a good track record of doing so. They also look at factors such as the payout ratio and dividend growth rate to determine the stability of the dividend payout. For growth investing, investors are looking for companies that have a solid business model, strong earnings growth, and a competitive advantage in their industry. They assess the company's revenue growth, earnings growth, and market share to determine its potential for future growth. Both dividend investing and growth investing have their pros and cons. Dividend investing provides a reliable source of income and is less risky than growth investing. However, it may not result in as much capital appreciation as growth investing. Growth investing, on the other hand, has the potential for higher returns but comes with a higher degree of risk. To achieve long-term wealth accumulation, investors need to strike a balance between dividend investing and growth investing. This involves diversifying their portfolio to include a mix of dividend-paying stocks and growth stocks. By doing so, they can benefit from both income generation and capital appreciation, while minimizing risk. It's also important to regularly monitor and adjust investment decisions based on market trends, economic conditions, and company performance to ensure the portfolio remains balanced and aligned with long-term goals. When it comes to dividend investing, evaluating and selecting the right stocks is crucial for long-term wealth accumulation. There are various factors that investors should consider before investing in dividend-paying stocks, and some of the most important ones include dividend yield, payout ratio, and dividend growth rate. Firstly, let's talk about dividend yield. This is the percentage of a company's stock price that is paid out as dividends to its shareholders. Generally, investors prefer higher dividend yields as it indicates that they will receive a higher return on their investment. However, it's important to note that high dividend yields can also be a red flag, as it can indicate that the company is struggling to grow or has limited opportunities for reinvestment. The next factor is the payout ratio, which is the percentage of a company's earnings that are paid out as dividends. Low payout ratio can indicate that the company is reinvesting its earnings into the business to fuel growth, while a high payout ratio can indicate that the company is paying out too much of its earnings as dividends and may not have enough funds for future growth. Lastly, investors should also consider the dividend growth rate, which is the percentage increase in a company's dividend payout over time. Companies that have a consistent track record of increasing their dividends year over year can be an attractive option for long-term investors as it can provide a steady stream of income and potentially even outpace inflation. Overall, evaluating and selecting dividend-paying stocks based on these factors can help investors make informed decisions and build a diversified portfolio that can provide long-term growth potential and a steady stream. When it comes to investing in growth stocks, there are certain metrics you should consider to determine whether a particular stock is worth investing in. These metrics include earnings growth, revenue growth, and market share. Earnings growth refers to the rate at which a company's earnings are growing. This is important because it shows whether the company is generating more profit over time. A company with consistent earnings growth is likely to be a good investment because it demonstrates that the company is well managed and has a strong business model. Revenue growth is another important metric to consider. This refers to the rate at which a company's revenue is growing. A company that is experiencing steady revenue growth is likely to be a good investment because it indicates that there is strong demand for the company's products or services. Market share is also an important metric to analyze when considering growth stocks. This refers to the percentage of total sales in a particular market that a company has. A company with a high market share is likely to be a good investment because it demonstrates that the company is a leader in its industry and has a competitive advantage over its peers. It's important to note that these metrics should not be evaluated in isolation but rather as part of a comprehensive analysis of a company's financial health. By analyzing earnings growth, revenue growth, and market share, you can gain a better understanding of a company's long-term growth potential and make informed investment decisions. Now, let's talk about the importance of balancing your portfolio between dividend-paying and growth stocks. This is a crucial step in achieving diversification and maximizing your long-term growth potential. Dividend-paying stocks are generally seen as more stable and reliable investments. They provide a steady stream of income through their regular dividend payouts. On the other hand, growth stocks are companies that are expected to grow at a faster rate than their peers. They reinvest their profits back into the business to fuel their growth. While dividend stocks are great for generating income, they may not always offer the same level of growth potential as growth stocks. Conversely, growth stocks may not provide the same level of stability and income as dividend stocks. To achieve a balanced portfolio, it's important to invest in both types of stocks. This helps to mitigate the risks of investing in a single stock or industry. It also ensures that your portfolio is not overly reliant on any one type of investment. When balancing your portfolio, consider your investment goals, risk tolerance, and time horizon. If you're looking for income and stability, you may want to allocate a larger portion of your portfolio to dividend stocks. On the other hand, if you have a longer time horizon and are willing to take on more risk, you may want to allocate more of your portfolio to growth stocks. Remember, the key to a successful portfolio is diversification. By investing in a mix of dividend-paying and growth stocks, you can achieve a well-rounded portfolio that offers both income and growth potential. As an investor, it's important to keep a close eye on your investments and make adjustments when necessary. This is particularly true when it comes to dividend and growth investing. Monitoring and adjusting your investment decisions based on market trends, economic conditions, and company performance can help you maximize your returns and minimize your risks. Market trends can have a significant impact on your investments. For example, if a particular sector is experiencing a downturn, it may be wise to reduce your exposure to that sector and look for opportunities elsewhere. Similarly, if a particular stock is experiencing a significant increase in demand, it may be worth considering increasing your investment in that stock. Economic conditions also play a critical role in your investment decisions. Factors such as interest rates, inflation, and unemployment can all impact the performance of your investments. For example, rising interest rates can negatively impact the performance of dividend-paying stocks, as investors may look for higher returns elsewhere. On the other hand, a growing economy can benefit growth stocks, as companies may see increased demand for their products or services. Finally, company performance is perhaps the most important factor to consider when monitoring and adjusting your investment decisions. This includes factors such as revenue growth, earnings growth, and profitability. If a company's performance is strong, it may be worth increasing your investment in that company. Conversely, if a company's performance is weak, it may be wise to reduce your exposure to that company or sell your shares altogether. In summary, monitoring and adjusting your investment decisions based on market trends, economic conditions, and company performance can help you maximize your returns and minimize your risks. It's important to stay informed and make informed decisions based on the latest information available. By doing so, you can achieve long-term wealth accumulation and financial success.